Preparing for a liquidity risk analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is liquidity risk, and why does it matter for a financial institution? Liquidity risk is the risk that a firm cannot meet cash obligations when due without incurring unacceptable losses. It matters because even a solvent institution can fail if funding disappears or assets cannot be monetized quickly. I would separate funding liquidity from market liquidity, then link both to survival, regulatory confidence, client trust, and the ability to continue normal business during stress, rather than becoming a forced seller. While answering, focus on defining liquidity risk, distinguishing inability to pay from insolvency, and explaining why confidence, funding access, asset monetization, and regulatory expectations make liquidity central to financial stability. Question 2. Can you explain the difference between LCR and NSFR? The LCR and NSFR answer different questions. The LCR asks whether the bank holds enough high-quality liquid assets to survive a 30-day stress outflow, while the NSFR asks whether longer-term assets are funded with stable liabilities over a one-year horizon. In an interview, I would emphasize numerator quality, denominator assumptions, and why a strong liquidity profile needs both short-term resilience and structural funding stability together. Make sure to cover the purpose of LCR and NSFR, their different horizons, how HQLA and stable funding are measured, and why both metrics matter for bank liquidity resilience. Question 3. How would you prepare and analyze a daily liquidity position report? I would start with opening cash and central bank balances, then add expected inflows and subtract contractual and behavioral outflows by currency, entity, and time bucket. I would reconcile treasury data to systems, flag large settlements, derivatives margin, wholesale maturities, and client concentrations. The output should show usable liquidity, not just accounting cash, because trapped, pledged, or operationally restricted balances may not fund stress needs. In your answer, talk about cash flow bucketing, usable versus restricted liquidity, data reconciliation, major inflow and outflow drivers, currency considerations, and how the report supports treasury decision-making. Question 4. How would you design a liquidity stress test for a bank? Good liquidity stress testing translates plausible shocks into cash flow impacts. I would build scenarios around idiosyncratic stress, market-wide stress, and a combined event. Then model deposit runoff, drawdowns, secured funding haircuts, collateral calls, and asset liquidation capacity. The key is not a perfect forecast. It is understanding survival horizon, management actions, weak points, and whether the contingency funding plan is credible under pressure for decision-makers. Be sure to mention idiosyncratic, market-wide, and combined scenarios, behavioral assumptions, runoff rates, margin calls, asset sale capacity, survival horizon, and how stress results feed management actions. Question 5. What makes an asset qualify as high-quality liquid assets, or HQLA? HQLA is valuable only if it can be converted into cash quickly and reliably during stress. I would look for low credit risk, deep markets, central bank eligibility, transparent pricing, and limited wrong-way correlation with the firm's own stress. Level 1 assets are strongest, while lower-level assets carry haircuts and caps. I would also test operational readiness, because securities are not truly liquid if they are pledged or inaccessible. While answering, focus on the definition of HQLA, levels and haircuts, convertibility to cash, operational availability, central bank eligibility, and why nominal liquidity can fail under stress. Question 6. What is a liquidity gap report, and how would you interpret it? A liquidity gap report maps expected inflows and outflows across time buckets such as overnight, 1 week, 1 month, and beyond. It shows where cumulative net cash needs appear and whether liquid resources cover them. I would challenge the assumptions behind rollover rates, client behavior, and contingent commitments, because the report can look comfortable contractually, but become tight once realistic stress behavior is included properly. Make sure to cover maturity buckets, contractual versus behavioral cash flows, cumulative gaps, assumption quality, and how gap reports reveal timing mismatches rather than just total liquidity needs. Question 7. How do you assess concentration risk in wholesale funding? Wholesale funding can be efficient, but it is confidence sensitive. If a bank relies heavily on a few counterparties, maturities, or currencies, a small confidence shock can create a large refinancing gap. I would measure top provider concentration, tenor cliffs, secured versus unsecured mix, and replacement cost. The risk response is diversification, longer tenor, committed backup lines, and pricing that reflects liquidity value rather than headline funding cost. In your answer, talk about rollover risk, provider concentration, tenor cliffs, secured versus unsecured funding, currency mismatches, and practical mitigants like diversification, term issuance, and committed facilities. Question 8. What is the difference between market liquidity risk and funding liquidity risk? Market liquidity is the ability to sell or hedge an asset near fair value. Funding liquidity is the ability to raise cash to meet obligations. They interact because falling market liquidity creates haircuts, margin calls, and forced sales, which then damages funding liquidity. I would explain that liquidity risk management must consider both sides, especially for trading books, repo financing, structured products, and positions whose liquidity vanishes in stress. Be sure to distinguish asset sale liquidity from cash funding capacity, then explain their feedback loop through haircuts, margin calls, forced selling, and loss of market confidence. Question 9. Which early warning indicators would you monitor for liquidity risk? Early warning indicators give management time before liquidity becomes a crisis. I would monitor deposit outflows, wholesale spread widening, CDS moves, rating outlooks, collateral disputes, unused commitment drawdowns, market depth, failed settlements, and intraday overdrafts. The best indicators have thresholds, owners, and escalation actions. I would avoid treating them as a dashboard only. They should trigger funding actions and contingency planning when trends deteriorate quickly. While answering, focus on measurable indicators, thresholds, escalation, ownership, and examples such as spread widening, deposit runoff, rating actions, settlement failures, and unusual collateral or drawdown activity. Question 10. What should be included in a contingency funding plan? A contingency funding plan is the playbook for a liquidity stress. I would expect clear triggers, governance, communication protocols, asset monetization options, backup funding sources, central bank access, and customer actions. It should rank actions by speed, size, certainty, and franchise impact. The important point is operational testing. A line or repo facility is useful only if documentation, collateral, and decision authority work under stress. Make sure to cover the purpose of a contingency funding plan, its triggers, governance, liquidity actions, communication plan, operational testing, and why theoretical funding sources must be executable. Question 11. Why is intraday liquidity risk important, even if the bank has enough end-of-day liquidity? Intraday liquidity matters because payment obligations arise throughout the day, not only at close. A bank may have enough end-of-day liquidity but still fail to settle if cash or credit is unavailable at the right hour. I would discuss payment queues, nostro balances, central bank accounts, security settlement, daylight overdrafts, and stress from delayed incoming payments. Monitoring timing is essential for operational resilience and counterparty confidence. In your answer, talk about payment timing, settlement obligations, nostro and central bank balances, daylight overdrafts, delayed receipts, and why end-of-day liquidity can hide intraday stress. Question 12. How would you model the liquidity behavior of retail or non-maturity deposits? Non-maturity deposits look stable contractually because customers can withdraw anytime, but behavior differs by segment, rate sensitivity, insurance coverage, and relationship depth. I would estimate core versus non-core balances using historical runoff, stress periods, concentration, and pricing beta. For liquidity risk, conservative assumptions matter because overstating deposit stickiness inflates survival horizon and may leave the institution underfunded during rapid outflow events or digital bank runs. Be sure to mention segmentation, core versus non-core balances, historical behavior, rate sensitivity, deposit insurance, concentration, and why behavioral assumptions can materially change projected liquidity needs. Question 13. How do collateral and margin requirements affect liquidity risk? Derivatives and secured financing can create liquidity needs exactly when markets move against the firm. I would model variation margin, initial margin increases, collateral substitution limits, rating triggers, and repo haircut changes. The analysis should identify eligible collateral by venue and currency, not just total securities owned. A strong analyst connects market shocks to cash calls, collateral mobility, encumbrance, and potential forced asset sales quickly. While answering, focus on how market moves create margin calls, haircut increases, collateral substitutions, rating triggers, encumbrance, and why eligible collateral must be analyzed by location and currency. Question 14. What role does funds transfer pricing play in liquidity risk management? Liquidity costs should be visible to the businesses that create them. Funds transfer pricing charges assets for their funding tenor and liquidity consumption, while crediting liabilities for stable funding value. If pricing is wrong, desks may originate profitable-looking assets that actually strain the balance sheet. I would mention FTP curves, behavioral maturity, optionality, regulatory costs, and how good pricing aligns business decisions with liquidity risk appetite. Make sure to cover how FTP allocates liquidity costs and benefits to businesses, including tenor, behavioral maturity, optionality, regulatory costs, and incentives for balance sheet discipline. Question 15. If the LCR suddenly drops close to the regulatory minimum, what would you do? If the LCR drops sharply, I would first validate data, timing, and classification before assuming a real breach. Then I would identify drivers: outflows, HQLA decline, FX constraint, collateral encumbrance, or business activity. I would escalate through governance, assess regulatory implications, and propose actions such as raising term funding, reducing outflows, monetizing eligible assets, or activating CFP steps. Speed matters, but so does accurate diagnosis. In your answer, talk about validating the metric, finding the actual drivers, escalating through governance, assessing regulatory impact, and proposing realistic actions without overreacting before the diagnosis is clear. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.